Cynthia's with us in Charleston, South Carolina. Hi, Cynthia. How are you?
I'm awesome. How are you?
Just the same. How can I help?
I have a question. I have, for a retirement account, I have an indexed universal life with a death benefit.
Mm-hmm.
And is that I know you don't like whole life policies, but is that indexed universal life something you would keep?
No. And here's a simple thing. When you combine investing and life insurance together, the investments never perform like they should because they get feed to death as they walk down the hallway of the life insurance company. That's what it comes down to. And the insurance ends up being expensive because it's all wrapped together, and it's very hard to undo it unless you really know a lot about the business. It's very hard to take the two parts, the investment part and the insurance stuff apart, and look at them and go, wow, that sucks. Oh, that sucks. Oh, this thing double sucks. And that's, but I've been doing it for years. And so here's what it comes down to. The indexed investment is going into index funds, typically. Sometimes it's going into other mutual funds, but either way, if you went straight to those mutual funds, you would make better rates of return because you wouldn't be paying extra fees that you're paying with the insurance product. Is that logical?
Yeah.
Okay. And then the usually in a universal life, not every time, but most every time, the insurance side of the product is what's called ART, annual renewable term. Now, let me talk that through with you just because it's kind of nerdy and fun, okay? Life insurance, the older you get, it costs more to cover you because you're more likely to die statistically. Does that make sense?
Mm-hmm.
So a 56-year-old pays more than a 55-year-old who pays more than a 45-year-old because the older you are, statistically, on average, you're more likely to die. Duh, right? So the pure insurance is every year it goes up based on your increased likelihood to die. That's pure insurance. Does that make sense to you?
Yeah.
That more accurately reflects the actual statistics. Now, that's called annual renewable term. Now, here's what's interesting about the life insurance world, though. You hear me talk about 15-year or 20-year level term, which means you pay one price every year, the same price level, for 15 whole years. It didn't go up, which what that tells you, if you think about it for a second, is all they did was take the average of the prices through the increase. Instead of going up every time for 15 times, they just took the average of that and they charge you one price, okay? Does that make sense?
Yep.
However, one of the big costs of life insurance is not just someone dying for the insurance company. One of the big costs is the commissions. And so if a type of policy will stay on their books longer than another type, it's cheaper for them, and that cost is typically passed on to you, the consumer, in lower premiums. 15-year policies stay on the books a lot better than annual renewable term does, and so a 15-year on average over the 15 years is going to be not just the average, but it's going to be cheaper. Does that make sense to you?
Mm-hmm.
Okay, now, then you take that ART over there and you say, oh, this universal life, basically I'm paying one price. Some of it's going to investing, some of it's going to insurance. But the portion that's going to insurance goes up every year. Therefore, the amount going to investments goes down every year. Does that make sense?
Yep.
That sucks too. I mean, if you just think about it, I don't want to be putting less in investments. I want to be putting more in investments. And they're going with the most expensive type of way to calculate the insurance because of the averages. So that's a lot of gobbledygook, but if you got half of it, you're starting to see why this doesn't work. You're better off to buy term insurance and do your investing straight into your 401k, into good mutual funds, or into your Roth IRA, into good mutual funds, without it being wrapped up and bundled up inside of an insurance product. Is that logical to you?
Yes. So what would you suggest that I move it into?
Well, it sounds like you're buying it inside of a retirement plan at work or something.
Well, it's not through work. It's through somebody it comes out of my checking, so it's after tax.
Oh, okay. So you just bought it from an insurance broker.
Yeah.
Okay. But so it's not in an IRA.
No, he said it's index universal
Okay.
life.
You just bought a life insurance policy. Yeah, it's not a retirement plan at all. It's just a way of investing money poorly. That's all it is. Okay, well, it's real simple. Get with Zander Insurance, ZanderINS.com, and get a quote for term life insurance. You should have 10 to 12 times your income on you. And if you're married, the same amount on your husband. He should have 10 to 12 times his income on him. Get that term insurance in place before you do anything, and then just cancel this stuff. And then it's going to save you a ton of money. A ton of money. And that will enable you then to invest into your Roth IRA and some good mutual funds.
I have life insurance through work.
Okay.
So do I still need to get...
how much do you have through work?
Well, I guess it's... I don't actually know.
Okay, well, that's the thing to find out. You need about 10 to 12 times on you. If you've got that much at work, you probably ought to get a policy outside of work anyway, not necessarily a huge one, but some, because if you ever got some kind of a medical event, like a cancer scare or got diabetes or heart problem or something like that, and then you left work, you would leave your insurance back there at work and you wouldn't be insurable for new life insurance out in the marketplace. So we always recommend you have some outside of work, but usually you have 1 to 5 times your income in your group plan at work, which is not enough. So you probably want to supplement that outside. But all I'm saying is don't cancel this universal life, even though I don't like it, until you have other insurance in place, because I don't want you to die in between and leave a mess.
Right.
So just get the right insurance in place, then cancel this stuff, and then you can sit down with your investment professional and get a real investment going directly into mutual funds, into a Roth IRA, and it'll just do a whole lot better. But basically, the universal life it's the same thing as whole life. It's a more modern version, but after the fees, the average universal life, indexed and everything, after fees, not their quoted rates, not what their brochures say, but the real world when the actual research is done. This is the amount of money should have gone to insurance. This is the amount of money should have gone into the investment. And then we can back out and we can actually mathematically calculate what the investment return is. On average, it's about 4.7%, where the average mutual fund is 10 to 12%. And so that tells you that that money's going somewhere other than to you. That's what it amounts to. Just a bad product. That's what it comes down to. This is the Dave Ramsey Show. Hey guys, thanks for watching. If you enjoyed this video, click the subscribe button to get the latest content and check out these other great clips from the show. You can do this. That really is the message. Whether you've got $270,000 in student loan debt or $27,000, whether you've got a $50,000 income or a $500,000 income,